In 2022, international financial funds significantly withdrew from China. In the first quarter of 2023, the outflow trend continued. To help readers better understand this trend, let me tell you two stories. The first story is about the turnaround of two good friends of the Chinese Communist Party, CCP. The first is Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates. Dalio, who had been bullish on China for decades, has warned about problems under CCP rule 3 times in the past 6 months. His latest warning was on April 26, when he wrote on his LinkedIn account that the United States and China are on the brink of war and that the two sides can no longer communicate. The next 18 months will be a very dangerous period. He specifically talked about the political environment in China, saying that the CCP's governance now is more dictatorial and authoritarian. China is now a highly controlled environment, and it is an anti-elite and pro-proletariat environment. Dalio made these comments after spending 13 days in Beijing. During that time, he attended the China Development Forum 2023 annual meeting, met with officials such as the chairman of the China Banking and Insurance Regulatory Commission, Guo Shiqing, and also went to Shanghai to meet with the Shanghai Party Secretary, Chen Jining. The second is Mark Mobius, a U.S. billionaire known as the father of emerging markets. Mobius, who had been bullish on China for decades, was still emphasizing the need to invest in China for the next 10 years at the end of February. However, on March 2, in an interview with Fox Business, Mobius said, "I have an account with HSBC in Shanghai. I can't take the money out. The government is restricting the flow of funds out of China. I can't explain why they're doing this, they've set up all sorts of barriers. They won't say no, you can't take the money out. But they'll say, give us a record of how you've made money for the past 20 years, it's crazy." Therefore, he warned investors to be very, very cautious when investing in economies that are tightly controlled by the government. The second story is about the breakup of SoftBank and Alibaba. On April 12, media reports stated that SoftBank Group, led by Masayoshi Son, had sold about $7.2 billion worth of Alibaba stock through prepaid forward contracts since the beginning of this year, following last year's record-breaking $29 billion sale. After the news was announced, Alibaba's U.S. stock fell 4% in after-hours trading. Since SoftBank first invested in Alibaba in 2000, the two have maintained a long-term partnership that lasted for more than 20 years, with Jack Ma and Masayoshi Son at the helm. However, in recent years, factors such as Jack Ma's disappearance, Alibaba's breakup, and SoftBank's massive investment losses have resulted in SoftBank now only holding a symbolic 3.8% stake in Alibaba. These two stories indicate that international capital is re-evaluating its relationship with the CCP and that an era is coming to an end. Since an era is closing, international capital will naturally flow out of China. Here, we introduce the situation in the first quarter of 2023. Firstly, the stock market. At the end of 2022, the Chinese Communist Party suddenly terminated the dynamic zeroing policy, giving foreign investors a dizzying illusion. In January 2023, the cumulative net buying of northbound funds reached 141.29 billion yuan, not only breaking the record for monthly net inflows, but also exceeding the net buying amount for the entire year of 2022, 90.02 billion yuan. However, in February, it quickly fell back, with a net inflow of only 9.258 billion yuan. In March, it rebounded, with a net inflow of 35.44 billion yuan. But in April, the A-share market fluctuated, and the net outflow of northbound funds was 4.553 billion yuan. This indicates that with the background of both international and domestic tensions, the effect of the termination of dynamic zeroing has been fully released, and northbound funds are returning to their normal withdrawal mode. Secondly, the bond market. In January, despite the influx of northbound funds into the A-share market, overseas institutions were not interested in the Chinese bond market. The custodian scale of the main bond types decreased by 106.6 billion yuan month-on-month, recording the largest decline since March 2022. After increasing holdings last month, they turned to reduce holdings again. The main types of bonds that were reduced were interest rate bonds, national debt, minus 66.3 billion yuan. In February, overseas institutions continued to reduce their holdings of 75.4 billion yuan of bonds. In March, they slightly increased their holdings by 3.5 billion yuan. As of the end of March 2023, the custodian balance of overseas institutions in the Chinese bond market has dropped to 3.3 trillion yuan, accounting for 2.2% of the custodian balance in the Chinese bond market. The above belong to financial funds. Foreign capital also has an important category, industrial capital, that is, foreign direct investment, FDI. According to official data from the Chinese government, FDI has been very high since 2020, ranking first in the world. In the first quarter of 2023, the Chinese Ministry of Commerce once again claimed that it has achieved a stable opening for attracting foreign investment. The actual use of foreign investment in the country was 408.45 billion yuan, a year-on-year increase of 4.9%. In the past 2 years, articles questioning is foreign investment first in China? And the mystery of China's absorption of foreign direct investment were published. However, because the data is in the hands of the Chinese government, and the Chinese government is good at playing with numbers, it is difficult to investigate deeply. However, I recently read a research article published by the IMF on April 6, which mentioned that the situation of foreign direct investment flowing into China is not good. The relevant part is quoted below for readers' reference. Strategic foreign direct investment flowing into Asian countries began to decline in 2019, and has only slightly recovered in recent quarters, but foreign direct investment flowing into China has not yet recovered. Why is that? The article reveals a major background. In the past decade, the proportion of foreign direct investment flows between economically aligned geopolitical entities has continued to increase, surpassing that of countries with closer geographical proximity. This indicates that geopolitical preferences are playing an increasingly important role in determining the location of foreign direct investment. In other words, China's wolf warrior diplomacy is driving the decoupling of China and the West in terms of economics and technology. From the two stories mentioned at the beginning of the article and the performance of foreign investment in the Chinese stock and bond markets in the first quarter of this year, it is undeniable that the trend of foreign withdrawal from China is taking place.